Hello everyone, welcome back to another video. Today we're going to be talking about a very important topic when you're looking to buy a business. How do you analyze a confidential information memorandum or a CIM effectively? And so just as a background, I'm a Canadian investment banker focused on the lower end of the middle market. So I play in that $2 to $50 million enterprise value range. And I thought I would share my perspective on when I look at a client and I help a client buy a company and I look at a CIM, what are the questions I'm asking for? What are the things I'm looking to spot on each individual section of the CIM? And hopefully that will allow you to more effectively analyze opportunities in the future. Now, if you're interested in even digging deeper into this, what I actually do is you can go into the video link description there and click on my website, and you can actually book a 1-hour session with me where I will be that sounding board, review an opportunity with you, kind of teach you and really kind of fly along with you to help you analyze the opportunity. But hopefully these next couple of videos are going to give you enough detail to hopefully allow you to analyze more effectively these opportunities. So let's jump into it. So what is a confidential information memorandum? Well, it's the primary selling document that most M&A advisors use to sell a business. And this document is really aimed to summarize the business's operations and tell the story behind why the company is selling, number one. And then two, what are the growth opportunities for the next ownership group? Now, usually the format and the presented content is fairly standardized across the sector. So really the headers, the sections that the CIM breaks down the opportunity into are very common. And so really the way I'm approaching this video is it's tough to train someone on analyzing one specific CIM. What I want to do is focus more on the key questions to consider in each section and apply them across a broad range of opportunities so that it's not just specific to one sector or specific to one type of CIM. Okay, so when you look at the different sections within a confidential information memorandum, here are the common headers. Starts off obviously with just an overview of the operations and the products or services. Then it'll go into a customer section, then the supplier section if there are suppliers. Then there's the employee organizational chart, so a summary of the employees and the key staff. Then there's maybe some commentary around the real estate. So is the property leased? Is it owned? How big is it? Then legal and IT systems. Then there's the ownership structure. So how is the business owned? What are the entities that hold the shares? What's the percentage split? And then lastly, the back half of the package is the financials. So the income statement, the balance sheet, the EBITDA normalization that's used to obviously value the business. And then sometimes there may be an asset list or an equipment list that breaks down the key valuable assets within a business. And so the way I'm going to approach this is there's going to be 3 parts to the video series. The first part, I'm going to focus on the most important section, which funny enough is the last half. It's the financials. So I'm going to focus in this video on the financial side. The next video, I'm going to focus on the operations, customers, suppliers, and how to really analyze a business from a business mindset point of view. What are the drivers and limiters of that business? And then the third part video is going to be more on the employees, real estate, IT, and the ownership structure, and thinking through the psychology of how to analyze an opportunity from the lens of employees or ownership. Okay, so hopefully that gives you a good overview. So let's jump into it. So even before we get into the financial section, I always start off by really understanding outside of the CIM, outside of the vetted document that the broker puts together where, the seller and their advisor go over with a fine-tooth comb and understand and confirm the wording that is presented to the buyers, we want to find the juicy details around the CIM that's not really in the document. So really that only comes through more discussion and more research on the business and dealing with the broker. Because usually the client is going to be behind the broker, so you're not going to really have a chance to deal with the client maybe until you put in an offer. Sometimes they'll let you, but most times, even for me, I mostly focus on selling businesses, and I don't let any buyer get in front of my client before they have a viable, qualified, competitive offer in front of that client. So really, the best way for you to gather information outside of the CIM is to lean on the M&A advisor and have a 1-hour conversation with them and ask them really high quality questions. And so here are some of the questions that I would really approach. And the way I kind of put the hat on it, and I put this little image here, is you kind of want to be almost like an investigative journalist. You really want to ask the questions that need to be asked and really ask them maybe twice over to really confirm what the broker is trying to tell you. And sometimes some brokers are really mature and they realize that they can't put the full story on paper in writing, but over phone they can communicate some additional elements, versus other brokers may hide those elements. It depends on the type of broker that you're dealing with in your relationship with that advisor. But don't be lazy. Pick up the phone and actually have the conversation with the broker, because that is going to be the best way to find out those outside non-CIM details. So what are the things to ask for? Well, the first one obviously is the why. Why is this seller selling? What's really kind of pushing them towards the exit? And I have a separate video that really covers in detail the psychology behind why a seller sells. But you really want to understand from the broker's point of view, well, why did they approach you? How did you get the opportunity? Why is today the right time? Is it an age discussion? How old are they? Why don't they hold on? Why don't they sell to their management team? Have they explored those options? So really digging into, why does it make sense to sell to a third party versus just holding on or maybe selling to the children or the management team. The second one, very important one, most people don't ask it, is how long has the business been on the market for? When did you take it to market? When was the first time you went live with this opportunity? Is this a 6-month-old opportunity or is this a 2-week-old opportunity? The longer it's been on the market, obviously, the more you know that probably there's not a lot of buyers for the business, or it's taking a longer time to get to the finish line. And then the third bullet point there is this the first time they've tried to sell? And you'll be surprised that, oftentimes clients have, tried in the past, hired another broker, pulled it off the market, gone back to market another 5 years later. So you really want to understand, is this the first time they've tried selling the business? And this is another way to get around the second question, which is, maybe they refreshed the package, went to market, and then didn't work out. They took it off the market and they refreshed the pack and went again to market. And now they're saying, the second time we went to market, it's been on the market for 2 weeks. Well, that's not really the right answer. That's more of getting around the key answer, which is, no, we've tried selling the business before. So sometimes it's important to ask the question in a different way. So I really like the question of, is this the first time the business is for sale? Now, the fourth point there is, how did the broker find the opportunity? Did the client reach out to you? Did you pick up the phone and, contact them? Is there some edge there? Because what that shows is, who are the decision makers around the process? Was the client referred to the broker by a bank, for example? Or did the broker just solicit the client and plant the idea of selling in their head? Like, who really was the driver behind the idea of selling? Because that really also does influence how committed that client is. Because there's a big difference between the client reaching out to a broker, running an auction and saying, okay, I've chosen you to hire you to sell this business, versus the broker reaching out, planting the seed in their head, convincing them to sell, and then bringing them to market. Because now it's like, well, you told me I should sell. You told me I could get this offer. And if I don't get this offer, screw it. I'm not going to sell. So there's different layers to the story there as well. Now, another one is, how did the owner come to possess the business? Did they found the business, inherit it, or acquire it? And that's really important, because there's different emotions involved. I'll start with the last one, acquire. Well, if they acquired the business, they're more transactional oriented with regards to that opportunity, because they came into it, they bought it, they understand the acquisition process from the buyer side. So they're a little bit more mature, and I would say generally a little bit more unemotional when it comes to selling the business. It's the exact opposite if they founded the business. They probably never sold a business before, and this is their baby, and it's done very well for them and built them a lot of wealth, and now they're going to go and expose themselves to buyers and their opinions, and that means they're a lot more emotional about their business. The inherit one is interesting, because it can go both ways. Either they've inherited and they feel a sense of responsibility towards the family legacy and they want to find the right buyer, or they've inherited and they had no choice in choosing that path in their life and in their career. And I've seen that often where, they wake up in their 50s and they're like, you know what, I don't really like this business. I don't like this industry. I'm going to go and do my own thing. So it depends on the situation. Now, the other one is, how are the family members involved in the business? What are they doing? Why aren't they buying the business? So really, what is the story behind the family members? What are their objectives? It's not just the seller, but the family members also influence the seller's decision. The next one is, has the seller received any offers yet? So really, whereabouts in the process are you? And what are the offers that I've received to date? So say, for example, you ask the question, how long has it been on the market? 6 months. Okay, have they received any offers? Well, if they say no, then that's a really interesting situation. But if they received if the answer is yes, the next question is, okay, what type of offer does that look like? What was the value? What was the structure? Was it more cash down versus deferred? And some brokers may be, more coy and not give you that information, but at least try asking the question to see what type of new information you can get from that conversation. And so the next one is how is the broker's process? What does that mean? Like in terms of going to market, are they doing a broad auction? Are they contacting a lot of parties? That's another question here. Are you going out to 100 parties? Are you going out to 50 parties? How many weeks are you going to give for people to review the opportunity before they have to submit it to a bid deadline date? Are there going to be multiple offers, or are they just looking for a one and done offer? Really understanding the broker's process, and then that will give you a sense of how big of an auction or how competitive an auction like is the process. And I would say for us as a firm, we're much more auction like. So certain buyers will ask us about our process. They'll be like, "Oh, I don't want to play in an auction. I don't want to be in an auction." Okay, then don't participate. But that means you probably lost that buyer, or they just realized that, oh no, we're not playing around here. We can't get a deal. There's an auction process, and the stronger the advisor is behind the client, then really probably the higher the premium that you're going to have to pay to get that business. And then the basic and logical question, which it amazes me how many buyers don't ask it point blank, is what valuation expectations does the client have? What type of valuation guidance can you give me? And oftentimes for me, as an advisor, I want to get a good price for the client, but I also want to move on. Like I don't want to sit on a deal for 2 years. I really want to find a good buyer, qualified buyer, get to a price that the client's happy with, but then I'm not going to hold out for every last dollar. That's just my philosophy in terms of how I sell a business. So really, I usually do give more valuation guidance than most advisors because, hey, listen, at the end of the day, this is what the client's looking for. Can you get there or not? And if you can't, then don't participate. Don't waste people's time. Now, the other one, and there's multiple subsets to this question, is what is the seller looking for? And this is key because, when you're thinking about analyzing a business, you have your expectations of what you want to pay for the business, how you want to structure it, but you can't really figure that out before understanding what the seller's objectives are. And it's not just asking the question of what are the seller's objectives, it's really asking the sub-questions. So what are the seller's transition expectations? Meaning, how long do they want to stay on and work in the business? Are they open to staying on for 1 to 2 years and they're not really interested in just fully stopping from working? Or are they just burnt out and they want to get out of this thing as fast as possible? Because that means the quicker the transition period, the more opportunity there may be to offer a lower price but a shorter transition period versus another group that maybe doesn't feel as comfortable in taking on that transition risk. Another one is taking care of the staff. So understanding the objectives of the staff. Are they firstly aware of the sale? Has the owner tried to sell the business to the staff? Oh, why not? Oh, because they don't have money? Okay, well, is there a way for you to structure an offer where you can actually take care of key employees, potentially give them an equity buy-in pool to allow them to own a share of the business? And from the seller's point of view, when they compare a fairly similar offer and one offer gives them 100% exit versus the offer gives them 100% exit plus the ability for their staff that have helped them get there to actually get a piece of the business, they always lean towards the key staff getting a piece of the business. So that's another way to make your offer stand out. The other one, and it's a big one, is what about seller financing? Is the seller open to seller financing? And obviously no seller is going to say, yeah, I don't want cash, I want seller financing. But the question is more, how much do they want and what are their emotions around the different types of seller financing? Are they at all even or open to an earnout, or have they heard all the bad stories and they're so afraid of an earnout that they'd rather take a lower price deal that has a fixed structure versus a higher price deal that has a variable structure? Depends on the situation, depends on the client. I've seen certain clients that have turned down 10-20% higher prices simply because that higher priced offer had a larger contingent portion of the purchase price based on performance versus the other one was mostly cash, maybe some VTB, where it's more just a fixed payment. So it depends on the type of seller, but really understanding, is a seller A, educated about these different types of structures, and B, what are they more open to? And then lastly, the type of buyer. So firstly, you could ask the broker and say, who have you gone out to? Have you gone out to strategics, firstly? Have you contacted their competitors? Because then, if you know that there are a lot of competitors in the space, that the sector's consolidating, it'll be tougher for you to stand out as a financial buyer if you're competing against competitors. But other sellers don't want to. So right now we're selling a big $20 million business, and the seller said, "Well, listen, like I can't go to my competitors because there's only three of them, and I don't want them knowing that we're for sale." So most of the buyers in the process are financial, family office, private equity. So the next question is, is their openness towards the type of buyer? Are they open towards a younger operator that wants to learn from them and work with them for a couple of years? Or do they want that quick exit with a competent operator that's in the space that doesn't really need them to stick around for a long time? Do they like private equity, or have they heard bad stories about private equity? Just getting an understanding of the types of groups, because really what you're trying to figure out in your mind is how big is the buyer pool. The bigger the buyer pool, the more competitive you have to be, the sharper your pencil is. But if you can kind of scale that buyer pool down and realize, oh my gosh, there's probably not a lot of people that are going to look at buying this business because it's too small, or the seller really has specific expectations. Can I structure a deal? Not getting a deal in terms of lowballing them, but structure a deal that just enough value that they feel like they're getting what they want, but at the same time, I feel like I'm getting a deal. That's really kind of the logic and the thinking around these conversations. So let's go into the first financial slide. So I always start off with the income statement slide. And so the way I'm going to try to talk through these slides is really to give you a couple key questions to think about. So when I open up a CIM and I start looking at the income statement slide, I'm really looking to understand, firstly, what are the trends? What are the trends in the last 4 years? That's really kind of the last 4 years are the most relevant years, subject to maybe some COVID years, where you have to kind of exclude a year or two. But in a situation where the business is steady state, there's no real global pandemic influencing the business, what is the trend of sales? It is between 2019 to 2022, have sales consistently gone up? Are they swinging up and down? What does that look like? And there are two key areas that I really focus on. The first is the gross margin. So the percentage of gross margin. Some brokers, they include that in the CIM. Others, you have to kind of calculate it yourself, which is a little tedious, but whatever. And then as well, the operating cost to sales margin. So meaning my operating costs below the gross margin line relative to the top line, are they scaling up? Are they scaling down? And that will really communicate how variable the costs are, and is there benefits to leverage? Because in a business that has that has a declining historical OPEX to sales margin, as the sales go up, that means you're getting more leverage on your costs as you're increasing your sales, and therefore that's beneficial, and it will reward you with a higher and steadily higher profit margin over time as you continue to grow the business. So really understanding that. So and then another one is cost of goods. So sometimes, especially with lower mid-market accountants, how cost of goods is calculated varies depending on the accountant. And sometimes cost of goods is not accurately calculated because there's no overhead applied to the direct cost. So say, for example, cost of goods could be the materials used to make the product or service. It could be the direct labor used to deliver that product or service. But then what other things could go in there? Well, some people put rent in there. Some people put utilities in there. Some people put overhead costs. Some people put foreign exchange, delivery, freight, all these different types of additional costs. So what I always like to do, especially when I look at the financials, is understand what is cost of goods made up of. And sometimes cost of goods in the gross margin is actually inflated because there's not the true cost, direct cost included in cost of goods. So the ideal is that you can ask the broker, and maybe they'll give it to you, maybe they won't, but can I see this accountant prepared financials, the source financials, so you can actually go and see the accountant's notes and see how they calculate cost of goods. Other times, the CIM may already provide a breakdown of cost of goods. Depends on the situation. But really understanding how cost of goods is calculated will influence your analysis around the historical gross margin. Another one that I quickly always zero in on is there rent included? Because oftentimes with these smaller businesses, the business owns the property, and sometimes the ownership group does not pay rent to themselves because they own the property. Why did they need to, right? Like, I'm just going to take a salary. I have a bunch of cash in the business. I don't really need to pay myself rent. But that means that there's probably a normalization involved in rent, which we'll get into. But just confirm on the income statement if the rent is actually paid. And in this situation, for example, you can see right here, property rent is paid. So just make a mental note The next question when we get into the EBITDA slide is that market? Is that appropriate, or should we normalize up or down for that market rent? Another one is professional fees. So that's one because it really shows you, if there's any lawsuits, the complexity of the ownership group and their expectations around readying the business for sale. And usually professional fees start to spike up as a business goes to market because they're retaining tax, accounting, legal, and M&A advice. So is there some sort of trend there that maybe may result in a normalization? And so you can see here in this business, the professional fees in the first year were $9,000. It spiked to $25,000, $41,000, and back down to $11,000. So these 2 years were higher than normal. Why is that? Maybe ask that question for the broker to see. And then the last one is advertising. So advertising gives you a really good glimpse into the type of business. Usually a B2B business or something that's very niche and specific, the advertising expense is going to be very low because they don't really need to advertise. Everyone kind of knows them. That's a very niche market versus maybe a B2C type business or a business where they're dealing with a broader range of customers and it's a very competitive landscape, then they may need to advertise more. And so certain buyers like high advertising businesses because they can optimize that with their past experiences versus other buyers, they don't want to get into the knife fight that is advertising where you have to consistently reinvest and keep spending to really stand out in SEO and whatever. So what type of business does it look like from an advertising perspective? So I always look at that line as well. And so here I see that advertising is about in the mid, $20,000 to $30,000 range on a $6 million business. I would say that's like middle of the park, nothing really substantial. Now, if that was $100,000 or $200,000 on a $5 million, $6 million sales business, that's probably high. And so understanding, does that come with the territory in this business? Why do they have to spend so much money on advertising? Are they spending it because they're choosing to spend on it to develop an edge? Or does that just come with the territory that is playing in this marketplace? So really, I try to read the financials and tie it back to the business case to really understand, what type of business are we playing in? Is this a business where you can maintain very high margins and not reinvest in the brand? What type of business does that look like? And so just really from an overview point of view, whenever you look at these financials, always try to pay attention to certain trends, whether it's big changes up or down in costs. So let's actually just do this. So I've actually taken this, and this is like the blank version, and now I've applied, highlights to certain areas to show you exactly where my mind would go and the calculations that I would do in an Excel model. So firstly, as I mentioned, I included the gross margin now. And so here my comment is this is a really stable business. It's a clean business because the gross margin is pretty flat. It's 37, 35, 36, 37. So that's rock steady, especially as the business has gone up in size. They've been able to maintain their gross margin. So they're not giving away, margin to increase sales. They're maintaining their margin, which is a sign of a healthy business. The other one is OPEX. So here, OPEX has gone down from 20, 18, 18, 17. So as I mentioned, as sales are going up, if your OPEX percentage is going down, that means that you're getting better scale on your sales, which is a positive sign in terms of scaling the business. This would be if it was the exact opposite. If this was 20, 21, 22, 25, why do you have to invest more in people and more infrastructure, IT infrastructure, advertising to really grow? Why is OPEX going up instead of scaling down? Now, in the middle part here in the expenses side of the business, I really zeroed in on big differences year over year. And so the first one is in the wages and payroll is why did payroll costs in 2019 go from 630 down to 450 and then back up to 542? Something happened there. And then it went back up to 710. So that is there potentially, and I know this business, so in this situation, it was actually, they applied their COVID subsidies against that. So they didn't let go of anyone, but they received subsidies. And sometimes the accountants include that in the wages expense line versus other times they'll exclude it and then put it below the operating income line in other income. Or maybe even sometimes they include it in sales. So it all depends on the type of how the business prepares their financials. But here, after a little bit of digging, you would uncover that actually the COVID subsidy is included in this. And when you back it out, it's a fairly steady trend. And so 2019 was a little bit higher than 2021 because same thing, 2021 had a little bit more cost, the COVID subsidies, but there was no subsidies in 2022. So by then, really your business has grown from 4.9 million to 6 million, and your wage bill has also increased proportionally, which makes sense. It's consistent. Now that explains away the difference. Now, another one that I zero in on is insurance. So now this is more of an experience comment, because as you start looking at more and more businesses, you'll be able to start grouping some of these expenses relative to industry peers or the relative size of the business. And so I know for a business in the $5 to $10 million sales range, usually your insurance would be anywhere from $10,000 to $20,000. So $6,000 either means there's insurance in cost of goods that's recategorized up there, which there isn't, or the insurance is very low. So why is it low? Do they have to carry a lot of insurance? Is this a business that needs insurance, or are they underinsured? And I would say for most business owners that have owned their properties, that have owned their business for 20, 30 years, they view risk a very different way than a new business owner that's going to be levered. So really from an insurance point of view, I would say not most of the time, but a good third of the time, businesses are underinsured. And so the cost associated with insurance is lower than it should be. And so in your buyer model, you should be factoring in an increase to your insurance expense to factor in the fact that this is not the case. So it depends. Sometimes this may be normal because they own no vehicles, and therefore this is maybe just property insurance. But what about general and commercial liability insurance? What about directors and officers liability insurance? Do you need those insurance policies as a buyer? Because if so, regardless of what the business needs to carry, you have your specific needs and you need to factor that in when you're analyzing a business to buy. Now, we already talked about professional fees. You could see a spike here in these 2 years, and it goes back down. So probably there was some pre-sale tax planning, accounting advice there that needs to be normalized. Here, automotive and delivery. So there was a drop off from 16,000 to 6 back to 11 and then 12. But because it was COVID and there was the shutdowns, most likely their delivering expense just went down relative to their sales as well. So that is explainable. And then another one is repairs and maintenance. So here, this spikes from 2 to 23,000 and then back to 1 and 1. So what happened here? So this would be something you put in an email and you send to the broker and say, hey, I saw that repairs and maintenance jumped up in 2020. What happened? And so again, I know kind of the story behind this. There was a delivery truck that went down. They had to change out the engine. And so that was the case. So then really the next question is, okay, you have to change the engine. What is the useful life of these assets? When's the next time you have to change the engine? How many delivery trucks do you have? When's the next time I need to factor in a repairs and maintenance big lumpy cost? Is that going to come up in the very next year, or is it going to be another couple of years? So these are some of the questions you need to think about as a buyer when you're trying to understand the financial trends. So let's now look at another example. So here, this one's a bit more messy. It's a plastics manufacturing business, and there's a lot going on. So I've already kind of pre-highlighted the sections to look into, and here are the things, again, that I'd be looking for. So just looking at the very top, my first question is, what are the trends in this business? Okay, so in 2014, it was doing $12 million. It dropped off significantly in 2015. Then it jumped back up right away to 13 million, and it's steadily gone up to about 13.5. Okay, so what happened in 2015? Sometimes the CIM will tell you that, sometimes it won't, and you have to follow up with the broker. Next one is the gross margin. So here, gross margin was low in 2014 at 27, jumps up to 33, 32, and then drops down. So what happened there? Oops, I clicked accidentally. So what happened there? Well, in that situation, your sales are increasing and your gross margin actually come down. So have they taken on less profitable work? What type of projects? So in this situation, because it's a plastics manufacturing business, and I just know the space, there's usually about 6 to 12 months worth of project pipeline. Key question for a buyer then is going to be, well, if your margins are going down, can I look at the next 12 months of projected earnings and understand where your margin is going to be in 2018, for example? Because if it's going to be around the same level, then were these 2 years in the 33s and the 32 high, abnormally high? And really the true gross margin for this type of work is usually in the high 20s, in the 27, 28, 29 range. Or is it the opposite where, maybe they mispriced, there was some error, and you can go back up to 33, but with better management. So just understanding, is this a glass half empty or glass half full situation? Like what is really abnormal versus normal? And this is, again, a very classic situation where you won't be able to know that by reading the CIM. You look at it, you understand the historical trends, and then you make some comments, and then you either go to the broker and you ask for that. And sometimes the broker may not be able to give you that information, and they'll say, make me an offer. Okay, make you an offer. Make you an offer subject to this. And then when you get in front of in front of the seller, that's when you actually have a more detailed operational discussion around these types of trends. So looking down, so advertising about 16, 18, ooh, big jump there, wonder why. But, same thing. This is probably a pretty standard advertising budget. It's not a high advertising spend business because it's, plastics manufacturing. But here's a big one, and you see this sometimes is bad debts, these lumpy bad debts. So my first comment is, why are these bad debts here? What happened? And when did the actual sale occur associated with that bad debt? Did you sell? Are you clearing out bad debts from historical AR? And this is stuff that you sold 5 years ago. And that happens sometimes because sometimes you just let this buildup of AR happen and then you just want to clean it up before the company sells. Or did you actually sell that $173,000 in the same year or the year prior, and now you're writing it off because that customer went bankrupt or, there was a dispute or whatever the case is. So understanding the story behind the bad debt and then also normalizing the associated impact. So say, for example, the sale happened in 2015. Well, if it happened in 2015, then the sales in this year have an extra 173,000 that were never really going to be collected anyways. So you may add this back, but then you make the same negative adjustment on this side to smooth out and normalize the true cash flow of that business in each period relative to the true collectible sales. So again, it depends on the situation, but here I would be digging in to understand, why does this happen? And then maybe even going back a couple years in the past and saying, okay, I have a 4-year view of this business. Can I see the last 4 years in terms of bad debt? Does this happen every other year? Because it happened in 2014, then again in 2016, or were these one-off cases? What happened there? Now, I mentioned insurance, so check out this business. So insurance here is $114,000, went up to $297, down to $95, down at $89. So I'd be definitely zeroing on this one to say, well, what is insurance? Is that just recategorized expenses that were incorrectly categorized into insurance? Or are there true insurance expenses there? Was it one-time insurance payments associated with maybe discretionary life insurance policies? Whatever the case is, really digging into and seeing that. I know the business, again, this was a situation where the business was making excess payments associated with insurance tied to life insurance policies that were discretionary in nature. So really the true insurance costs were close to that 80, 90,000, which is high for a manufacturer, but because they were a specialized manufacturer in tight space in an urban area, the insurance policy carried a higher associated cost because of the risk associated with that business being in such an urban area. So sometimes, again, just understanding the dynamics of why insurance is the way it is, why advertising is the way it is. Now, same thing here. This is rental. I know this business as well. The background is that they actually rent this space. They don't own it. So this is true market rent, and it's steadily going up, which kind of makes sense, except for this year, which, why did it go down instead of up? Then there's repairs and maintenance. So here's another one. So the last business we looked at, standard kind of, this was a distribution type business. They had very low repairs and maintenance because, well, you don't have a lot of equipment. You're just distributing stuff. Here it's a manufacturer. And so when you're looking at a manufacturing business, the repairs and maintenance budget actually is a good indicator of the quality of the equipment. The newer the equipment, the lower your R&M needs to be because you don't need to invest and maintain that equipment as much, versus the higher the R&M is, well, the more you actually need to invest in your equipment. So here, I know this business, just based on discussions with the broker, it has a lot of older equipment. So this makes sense to me that the R&M is a lot higher, but it's really high. Man, I'm investing $500,000 a year in 2017 to just do repairs and maintenance. So does that mean that we're on the last legs of this equipment, or can it be run for another 10 years? But this is just the cost of doing business and operating this type of equipment, $500,000 a year. So this is just, from a business analysis point of view, very high. So just understanding why that is and being comfortable with that is key. There's consulting fees, one off here of 43,000. So obviously, is that an add back? Why is that? And then another one is subcontracts. So sometimes there'll be sub trades, subcontractors. What does the business sub out? What are those things that they really zero in on? And is that something that you as a new owner can bring back in, maybe by hiring someone? So sometimes you'll see businesses in the manufacturing space that sub out the engineering and design side. And sometimes what buyers do is they buy that business and they're like, you know what, I'm giving excess margin away to that. I'm just going to hire a professional engineer on staff to do the drafting and design work so I don't have to sub it out anymore, and I'm bringing down my costs. So really understanding in this business, what are the subs? Why do they sub? Can they bring that back in-house? And here's a perfect example where 2014, 2015 was 200,000, 123,000, and it goes down to 30 and then 11. So did they bring in the subs in-house themselves already? Or were these just excess stuff that happened because of maybe non-recurring events or non-recurring projects that are abnormal and they needed to sub out for one-off type projects? So it depends on the situation. But again, I would ask and understand. And then lastly here, you look at amortization. So this business, the way the financials are presented, they actually recategorize advertising, management fees, and interest and bank debt below the operating income line. And then really the last one here is other income. So 44,000, 214,000, 5,000, 47,000. This huge spike in other income, this is more explainable for these 44 and somewhere in the 10s, 20, 30,000 range. Maybe it's interest income. Maybe there's some, rebates that come from suppliers, but 214,000 is a lot of money that flows right to the bottom line. So was that, one-off R&D credits, tax credits? Did they sell something? Maybe that's a equipment gain loss and the accountant defines other income as that. Sometimes they even, they mix up the names. And so just understanding why did other income spike in that to that range is important. So now moving on to the adjusted EBITDA slide. So we've looked at the income statement. We understand the trends. We understand kind of just the high level story, and that ties into the broader CIM that you're going to read. Now, when we go to the EBITDA slide, my very first question is the EBITDA presented correctly? We need to fact check the EBITDA to understand, as the broker, done a proper EBITDA analysis, or have they stretched in certain ways? And I would say for the vast majority of CIMs that I read, the broker usually stretches in some way or another. They exclude something, they missed something, or they just undervalue something because from the broker's point of view, they're incented to have a higher price on the business. And the easiest way to jack up the price and to juice up the price is always going to be to increase that EBITDA as high as you can. So certain brokers, I'm not accusing brokers of being aggressive and misrepresenting numbers, but there's just this natural bias that happens in the EBITDA section. So it's absolutely critical that you look at EBITDA through the lens of reality. Is this realistic? And so what are the common areas that EBITDA is misrepresented from the buyer point of view? Well, the first one, it's the most common one, is going to be the owner's salary. So when you're looking at a business, how many active owners are in the business today? How many senior level executives are going to need to be replaced because they're selling the business and they're maybe going to stay on for 1 or 2 years, but eventually they're going to need to leave. So just to keep it simple, say for example, there's one owner, one seller, okay, and that person is an active operator within the business today. Well, the next question is, how many hours do they work in the business? Well, if they work a full work week and they do 40 to 50 hours or 40 to 60 hours, great. They work like every other business owner, and you're just going to step into their shoes and you can price their salary relative to the salary of just whatever a market GM salary is for that industry. But say, for example, they work 90 hours in the business. The next question is, well, does that need 2 people? Because I'm not going to step in as the business buyer and do the same workload because I'm trying to work on the business, not in the business. So do I need to take an additional adjustment and actually factor in the salary of a second person? So one of the easiest ways to look at that is just look at the number of hours worked for that seller. And then, really from a market salary point of view, I can kind of lend my perspective being in Toronto, Canada. For a general manager, depending on the size of the business, I'd say the average normalization we take is anywhere from 150 to 250,000 per GM. So for a standard 40 to 60 hour work week, I would say for a 3 million EBITDA business is going to be 250. For $1 million EBITDA business, maybe 150. And I always ask whenever I talk to business buyers is, what do you expect in terms of salary out of this business? And most people will say 150 to 200, plus extra allowance and all that gets you to about 250 as well. Now, say for example, you're selling a 10 million EBITDA business. Well, then the market changes completely, and you can just go online and take a look. But if you're trying to recruit a PepsiCo executive, for example, you're not going to get them for 250. You're going to get them for 400 to 500. So again, as the business increases in size, the normalized salary for the general manager also increases to compensate just for the experience and the, again, competing employment opportunities that exist in that market for general managers that are looking to get hired. Now, the second most common area of misrepresentation is rent. And so your question as the buyer is first to understand, is the property owned or leased? If it's owned, then I always fact check the adjustment that is in the EBITDA schedule, if there is an adjustment, by the way. But if there is an adjustment, I always fact check it by actually going and looking up the property. So I take the business's address, go online, just take away the 152 Stewart Avenue East. I just take away the 152 and I say Stewart Avenue East, industrial properties for lease or office properties for lease, and then just Google that and see what is there and see what other competing listings are down the street to understand what market rates are for that area. And so sometimes they're easy to find. Other times you may need to pull up a Collier's report or a CBRE report and understand what market rates are in that area. But what you're trying to do is just confirm that the rent adjustment that they've taken in the EBITDA schedule is reflective of market rent. And sometimes I would say a seller doesn't want to take the full hit on rent. So they'll say, oh, well, you know what? I'm okay. I'm going to hold on to the property. I'm okay in just leasing this out at maybe 75% of market value, meaning instead of market value being $10 a square foot, I'll give you $7.50 a square foot. Okay, perfect. You can give me a sweetheart deal, but you as a buyer need to ensure that you're going to have that rate for at least 5 to 10 years. So 5 years, and then maybe 10 years in a good deal. So for us, usually our standard negotiation is 5 plus 5. We'll give you whatever market rate for the first 5 years, and then after 5 years, it jumps to market again. But say, for example, you take a sweetheart deal and you agree to a 3-year lease. Well, after 3 years, it's going to jump up to market anyways, because maybe that property owner is going to sell, and they're going to sell to another investor. And that investor has no real relationship with you. They're just going to want to maximize rent. So you don't want to end up in a situation where you've overpaid for the true EBITDA of this business. And anyways, I always tell the seller this, sweetheart deals are kind of dumb, because the reality is you're kind of hurting yourself as a seller if you enter into a below market rate lease and you eventually hit hard times, you need to sell that property and you go to market. Well, the investors that are going to look at that property are not going to pay you true market value, because the cap rate and the associated rental income from the tenant, which is the business that they sold, is at a lower rate than true market, and therefore they're going to pay a lower value than true market for the property. So even from the buyer's point of view, if the broker is saying, oh, no, we'll give you a sweetheart deal, I sometimes even would be as bold as saying, hey, by the way, you don't want to do that, because you're hurting yourself and you're hurting your ability to maximize the value of that property if you ever do want to sell it. Enter into true market rent. There's no real discussion around what market is, and then there's no real surprises, because from your point of view as the buyer, you've lowered the EBITDA, but at least you've kept it at the true EBITDA level, and you're buying based on a true sustainable EBITDA instead of something that's inflated for a couple of years until it gets adjusted down again. Okay. Now, on the flip side, say, for example, the property is leased. So in this situation, it's great. You don't really have to worry about what is market, because, again, if you're in a lease, for the term of that lease, the rate is what it is. But the question is, how much below market is that lease relative to how many years are left on the lease? So I've seen certain deals. Right now we're working with one where we're in 2024. They have lease till 2034. Okay, so 10-year lease, and it's a fantastic rate. So that's a sweetheart rate. But because it's under lease and because it's under lease for such a long time, the buyer's like, perfect, no question, I don't really need to adjust that or worry about that. I'm just going to take the EBITDA that you've presented as is. But say, for example, that is a sweetheart lease and there's 2 years left or 1 year left or maybe 2.5 years left. Well, the reality is it's going to take another 6 months to close this deal. And then you have 2 years left at that rate, but maybe I'm paying 5 times for the business. So really, when someone pays you 5 times for the business, they're looking for 5 years of sustainable cash flow based on the benchmark that I'm paying for. But I only have 2 years left on that sweetheart lease. And at the end of the 2 years, the property is obviously going to jump up to market. So really, when the lease is short on a below market rate lease, most buyers, most competent buyers are actually going to factor in an increase anyways and reduce the EBITDA from now. And maybe the excess 2 years of really, true kind of excess savings associated with a lower rental rate, you either pay that to the seller or you maybe give a present value or whatever the case is. But I would almost, in a situation where, anywhere from 2.5 to 3 years left on that lease, I would be very hesitant to give a higher value associated with that sweetheart rate. I would take the hit right away, lower the EBITDA, and make sure that we have, you're never going to step into a situation where you're overpaying for EBITDA. Now, the argument for the seller, and obviously for me on the sell side, is that there are times when maybe the business is steadily growing every year. They have baked in contracts, and in the next 2 years, EBITDA is going to continue to climb and therefore offset the declining impact of a higher rental rate. So my counter argument to that, and this is why it's a negotiation, is if there is true projected growth, then maybe you don't need to take the full hit on EBITDA in terms of reducing the increasing the market rent, increasing the market rate back to a higher level, because the EBITDA is going to eat into that and actually absorb some of that increase. So net, the EBITDA 2.5 years from now is still going to be about the same, maybe, or even more. So it depends on the situation, depends on the competitiveness of the process. But I'd say from a conservative point of view, in the next 1 to 2 years, if there's a short-term lease with a sweetheart deal, take the hit to EBITDA, make sure that it's lower. And most brokers aren't going to do that because obviously that lowers their EBITDA and the price of the business. Now, another one that people forget about is the key staff versus market salary normalization. So not only do I ask for the owner's salary and the amount of work, time, and effort that they put in, but I would go into the actual key staff and say for example, there's a VP of sales, a general manager, a controller. I would be asking for how many hours do they work? Do they work an ungodly amount of hours as well, and that's just the culture of the company? Or do they have a standard 9 to 5? What are their salaries? And what are their bonus structures in place? And so the reality is there may be a situation where a key staff a couple years from now is going to leave. And you don't want to be in a situation where that key staff, you have to go back to market and hire for that key staff at $60,000 more than they were making because that key staff was paid way below market. Firstly, from a transition risk point of view, if your key staff are already below market, then they're going to feel a compounding amount of pressure to actually find a new job or come to you as the new owner and say, hey, I was doing a favor for my buddy, the guy that sold, but now I don't really have a relationship with you, so I want to get up to market. And if you don't give me market rate, then I'm going to leave. And that puts you in a really tough position. So either they'll force your hand and make you give them the raise anyways, or when they leave, you're going to have to go back out to market and replace those people anyways at a higher rate. So really taking the hit to the key staff level is important as well. And most brokers don't do this. I've started to do this in the last couple of years because I had to misstep. 2 years ago, we took a business to market. I didn't think about that. We went to market, and a lot of strategic buyers were like, hold on a second, how much is the general manager making? $75,000. No. The GMs in our space make $125 at least. And so they were all applying a $50,000 hit to the EBITDA. And I realized, that's a fair comment. That's, definitely from buyer point of view, that's something that we have to factor in. So thankfully now we do that. That's why a lot of buyers like dealing with us, because we're very realistic with the EBITDA and we take the hits right up front to avoid this negotiation. But other brokers may not do this. So it's important to really focus on that one. Now, quickly going through this one here. So there's a couple other areas. The first one is other income. So, and this other income could be either if the business has a lot of cash on the balance sheet, has the broker remove the interest income that may be included in revenues. And so revenues are inflated, the income is inflated because of non-recurring interest income, which for you as a buyer, you're going to buy that business on a cash-free, debt-free basis so that interest income doesn't continue on with you. So they have to back that out. And then definitely in the last couple of years, certain brokers maybe were not removing the impact of the COVID grants or the one-time subsidies or maybe one-off grants that were given by the government. Those are things that are non-recurring. And so really you have to back those out as well as the buyer. I talked about professional fees. So definitely if you see a spike in professional fees, you need to understand what market is for SMEs in general for year-end professional accounting and some general legal advice throughout the year. And I would say for most SMEs, that $10,000 to $15,000, $10,000 to $20,000 range is perfect. So if you have a business that, say for example, it has $40,000 in excess professional fees, then there's probably some excess fees there that need to be adjusted, right? So if it's 40 and market's 20, then maybe you take the extra 20 and add that to your buyer buy side EBITDA model. And I would say most brokers don't really zero in on that. Like we do, because we're always looking at everything, but certain brokers may miss professional fees, and that's usually an upwards adjustment, which is beneficial for you as the buyer. The other one is insurance. So either the business is underinsured or overinsured. So really understanding, where does that insurance rate compare to market and making an adjustment there. I would say in certain instances, insurance may be a little bit high because of life insurance and discretionary policies. And, the business owner hasn't gone to market and shopped that agreement in 15 years because they're buddies with their broker, versus other times that insurance may be very low. So you just need to understand where that stands and make an adjustment accordingly. The other one is FX gains and losses. So, and this depends on the type of business. But say, for example, you have a business where 80% of your sales are in US dollars and 100% of your costs are in Canadian dollars. And I'm just putting myself in Canadian business shoes. Or it could be the opposite. Say, for example, you have 80% of your sales in euros and you have 100% of your costs in USD. You understanding the impact of FX and how that gets reported on the financial statements is key. Because the reality is, say, for example, there's big one-time gains that are in the other income section of the financial statements, and the broker has excluded that. The reality is those are true business costs because every year you're facing FX changes, gains, losses, and everything. Now, there may be other times where the business is so heavily reliant on FX gains that it makes up maybe 30, 40% of their profit. And so the question for you as the buyer is that condition going to continue on for the next couple of years? Do I want to pay based on, strengthening FX conditions, weakening FX conditions, or do I just want to normalize and exclude the impact of that? So I would say any realized gains losses should be factored in. Any unrealized gain losses should be adjusted out. And then use discretion in terms of the types of businesses that you're looking for. So I'll give you a really good example. We were working with a business where, and this is a Canadian business, they were a distribution business. They were ordering a vast majority of their product from the United States, and everything was in Canadian dollars. The challenge was when the Canadian dollar strengthened, meaning they could buy more than the year before with the same amount of money, their margins went up. But then when the Canadian dollar weakened, their margins went down. And so, when we're going through the EBITDA section slide, we included the realized gain losses, but certain buyers pushed back and said, you know what, listen, it was really good for that 1 year, but that's not something that's certain. That's not guaranteed. So we want to strip out all of that and just focus on before FX, what does this business truly make? And that may be the reality of certain businesses that you have to really price in the FX risk. So that's a tricky one. There's a lot of discussion there. I could go on for a couple of minutes, but ultimately it's important to really zero in on what you're comfortable in paying when it comes to the sustainability of the FX gains and losses. And then the last one, we talked about this already, is the inventory or bad debt adjustment. So either there may be a one-off bad debt that the broker is adding back. The question you have to ask is, when did that bad debt actually occur from a sale point of view, and make a corresponding adjustment in that period. It's ideal if it's in the same period, then it is what it is, because you just adjust it's a wash. But there may also be a situation where maybe in the previous year, sales are inflated, but then in the next year, you've added back your bad debt, and therefore you've inflated your EBITDA. So you would inflate your EBITDA, but then also reduce your sales in the previous year to make it a true smooth out effect. On the inventory side, there may be an adjustment or two. The question is, how regular are these adjustments happening? If this is a regular part of doing business, and this is the same thing for bad debts. I saw certain businesses in the consumer lending space, for example, where there's this every single year, 1% to 3% of their sales, there's bad debts. It's not logical for you to add back every single year of bad debt because that's a regular cost of doing business versus a one-off. So it's important to understand, are these one-off situations, or is this just a regular cost that comes with doing business? It's no different than a lender. You can't assume that the loan losses when you're buying a lending book are an add back, because that comes with the territory of doing loans. When you have loan losses, that means that you're pushing the fold, trying to get the highest profit for your loan book, but there are every now and then going to be losses, and that shouldn't be added back. So it depends again on the type of situation and how regular it actually happens. Alrighty, so let's look at a live example here. So this is a past company that we worked with, and so distribution business. The owner wanted to sell, was putting in long weeks, 70 plus hours, and he wanted to stay on for a couple years, but actually work a little bit less, and probably needed a number two beside him to help him scale the business. So when we start, we always start with the net income on the financial statements, and we go and build back up the EBITDA. So the first one is the amortization. Then there's the income taxes, then the removal of the non-business interest income, and this was actually categorized in the sales of the business. So we back that out because obviously that inflates the profit of the business, because a buyer's not going to step in and have the same GICs and cash balance on the balance sheet. Then we added back the expensed CapEx. So in a specific year, the owner actually bought a couple vehicles that he expensed on the P&L instead of capitalized on the balance sheet. And sometimes this happens with lower mid-market businesses. They just don't do proper accounting. And so it was good in the sense that they expensed it all and lowered the income in that year. So they paid less tax for the income in that year. But really from a true P&L point of view, that should have been capitalized. So that's added back. As well, there was excess professional fees. The owner had multiple shareholders and family trust situation. There was some legal things going on. So really, all these things that would really stay with the owner and not continue on with the business and the new owner. So really, in terms of true market cost for a business of this size, we took about a $20,000 annual professional fee normalization. So in this year, for example, was about 37,000. So the 17,000 excess was added back, and we assumed 20,000 for a new business buyer. The ERP, so they upgraded an ERP system, and so there was training costs, one-time costs, things that weren't capitalized, the IT asset section on the balance sheet, but were more just expense to the business. Those were added back as well. There was excess interim inventory space, so for a couple months, they sat on some extra inventory from one of their key suppliers, which allowed them to do the supplier a favor for them. But at the same time, this was not something that was going to recur in the future. So the cost for that space was added back. And then interestingly, there was an inventory write down. So in 2016, in the cost of goods, there was a $125,000 inventory write down that inflated the cost of goods and lowered the profit. But that inventory write down was really more just reducing the income, because really in the next year, they reversed that inventory write down and actually sold the inventory that they had written down. So really in the next year, the reversal inflated the profit because they booked sales on essentially zero cost. So we've normalized for the inventory write down by adjusting down the next year's profit, but adding back for the initial inventory write down year. Now, in terms of the salary normalization situation, as I mentioned, the owner was putting in 70-hour weeks. He was making about $150,000 today, drawing out of the business, but he wanted to stay on and continue to work, and was looking for about a $250,000 salary. So we increased the owner's salary by $100,000 to take it up to $250,000, and then we also factored in the cost of a second executive, a COO, to factor in for the excess hours that the owner worked of 70 plus hours a week. So we factored in a $150,000 adjustment to the second executive salary normalization. But you'll see here that in these 3 years, we didn't adjust for that. And the reason why is sometimes the owner workload changes year over year, subject to how the business grows. So because this business was growing at more of a very steep trajectory, 2013 it was doing $1 million, and now it's doing $3.6 million. Really, the workload of the seller in 2013 was a lot different than they are in 2017. And so we asked the seller, well, what were your average weeks like in 2013, 2014? And the seller was like, well, no, 30, 40 hours a week. No, only in the last couple of years have I really started to work like crazy, and I probably need some help in the office. So really the adjustment was made for these two most recent years to factor in the change in the workload of the owner. So that's kind of the logic behind this EBITDA schedule. Now, moving on to the other one, this is an example where same thing, is more of like a service type business. The owner was paying himself a lot. And there was a couple moving pieces within the business that required some adjustment. So a little bit more messy, but at least it goes to show you the different types of adjustments that you'll come across in your journey of buying a business. So again, we started with net income, added back the amortization. There were some one-time asset gains and disposal costs that were normalized to smooth out the income. So meaning in 2016, they had sold some equipment that booked a $38,000 profit to the P&L, and that was reversed out and removed from the income because that's not really reoccurring. That's something that happened on a one-off basis and doesn't really affect the true cash flow of the business. There is also interest on long-term debt. So the business had, some equipment loans, a little mini, like capital lease. And so that those capital leases would be paid out on closing because business is still on a cash-free, debt-free basis. So the interest expense associated with that is also added back. There was income taxes, that were added back, and here it was a negative because there was actually a recovery. So in that year, there was a loss. They actually recovered some income taxes, so that increased the profit of the business, and that's been smoothed out as well. The owner had some life insurance, so they every year was paying about $10,000 a year. And again, most business buyers don't take out life insurance, especially professional business buyers like private equity firms or financial investors. Versus business owners that have held on to a business for 30 years, they may expense certain policies through the business because it's tax advantageous for them. So this is a discretionary expense that's added back. Here as well, there was legal fees associated with a lawsuit that were, definitely not associated with the business. And so as part of the deal, we had carved out the liability associated with that lawsuit was to stay with the seller, and the seller would post up about $500,000 in escrow that would cover all future legal costs associated by assumed by the business moving forward. So that way the new owner didn't really have to write a check because there was escrow funds used to pay the legal fees and really cover off any potential liability for the business because we're trying to carve that off and deal with it separately and keep it with the seller. So that's how we structured that. There was also an excess salary. So the seller was paying themselves anywhere in the realm of $500,000 a year, and we had assumed a $150,000 normalized GM salary for a business of this size in the kind of $1 million EBITDA range. There was also a redundant controller salary add back. So what ended up happening here is there was this kind of part-time, semi-retired controller that wasn't doing a lot. Ultimately was let go in 2016, and the roles and responsibility of that person were simply absorbed by the owner and his accounting team. So they never really kind of went back to market to replace that role, so the excess salary was added back. There was also some bad debt normalization that occurred in 2014 that was added back. It's actually what triggered the legal case. There was an inventory adjustment in 2017 that wrote off some inventory. There was no reversal of the inventory, no planned reversal. It was just bad debt bad inventory that hadn't moved in 10 years. So that was truly just an inventory write down that we added back fully. And then there's some other vehicle, meals and entertainment, travel expenses, discretionary expenses that were expensed through the business by the owner that were added back. So as you can see here, this is a bit messier, very busy EBITDA schedule, but it goes to show you that every business has different add backs and situations depending on the type of business that you're looking at. But really, one key thing to keep in mind is when you're looking at an EBITDA schedule, you really want to understand A, how realistic are all these things? But then B, what is the trend of EBITDA? So here it's 700,000, 900,000, goes down to 600,000, then back up to this huge $1.6 million. So what's sustainable? And why is it sustainable? And so I like to look at the EBITDA margin because that's a better track of how profitable the business is. If it's very consistent, so for example, the last slide here, 14, 16, 18, 16, 18, pretty consistent EBITDA margin. That means probably steadily growing and maintaining versus here, it's 7, 8, 5, 14. Okay, 2017 seems to be a very high anomaly year. Why is that? Is that sustainable? How is a seller going to really react in terms of pricing and the risk associated with this? So there's a whole separate video on the channel around how to value businesses, but really my comment to you when you're looking at the adjusted EBITDA slide is just making sure that you have this percentage and that factors into your discussion around valuation as well. So let's moving on to the balance sheet slide. So similar to the income statement slide, you just want to really track any year-over-year changes in accounts and understand why those situations occurred. So the cash account is different. Like you don't really need to focus on the cash account as much because maybe there's dividends and draws that happen. So cash is more just discretionary for the owner. But really looking at the accounts receivable, how has the accounts receivable tracked relative to the sales of the business? So that's why I put this bottom tab here to say for this company, for example, it was doing 2.1, 2.7, 2.9. So it's steadily going up in size. How has the accounts receivable, inventory, and balance sheet accounts tracked the sales levels? And so here, the big jump is actually in 2019, where the AR essentially doubles, more than doubles, but the sales only goes up by under 200,000. So what happened? Why did AR spike in that year? That would be a key question for the broker to understand. I look at here this business, because it's a service-based business. There's no inventory, so it's prepaid, income taxes, mortgages, and that's it. But mortgages. What is mortgages? Because usually most businesses, you want to make sure that investments, mortgages, and property and your real estate is outside of the operating company. If it's in the operating company, there may be an issue. So here, mortgages is actually an investment that the business has made in a second position mortgage at another, like client. So really they're holding on to this investment. Now, thankfully it's cleaned up this year and it doesn't exist anymore, but that's probably, something to look into and understand. Well, was that a favor for a client or a supplier? Why did you do that? Or is that just a regular investment that you made through the company? And then also backing out the associated interest income that definitely is not business related in the EBITDA schedule to reflect the fact that there was a mortgage investment made through the business. Now here, due to related party, essentially means that the business has given cash to someone else to essentially lend into a situation. So and is owed that money. So where has that advance occurred? And that's the one question to ask. Any related party type transactions, if there's big swings in related party accounts, it's understanding it. Either you could take on related party money essentially from the seller and essentially finance the business, or maybe you're advancing funds to a subsidiary, to a related party entity. So understanding what happened there. And then in terms of the property and plant and equipment, in this situation, the business actually held the real estate in the same company, which complicates things. Because now if you wanted to go and buy the business only, well, the real estate is also in the same operating entity. So do you buy the business assets and not give the advantage of a share sale to the owner? Or does the owner have to move the real estate outside of the business entity and then trigger the tax associated with moving that asset outside the entity? So that adds a layer of complexity to this situation that needed to be negotiated, and that ultimately factored and structured the deal. The reality is, if there's ever a situation where you have both the business assets and the real estate assets in the same company, really to avoid triggering any additional cost to the seller, the best buyer is obviously going to be someone that buys both. So that the seller doesn't have to deal with it. So maybe whoever buys both has a discount on the aggregate package to make it easier for the seller. So there's different things in different situations to look out for. And then lastly, anytime you see long-term debt on the books, you really want to understand, well, what is financing? What do you need to finance in this business? Because there's no inventory. It's a very service-based business, low margin, but or very high margin, low capex. So the property and plant equipment, is this a mortgage associated with the property that the business owns? And in this situation, it was. So really, this is not really a business loan. It's more of a real estate loan. So it's not really relevant for just someone that's looking to buy the business because, well, it's going to get paid out anyways. And it's not like the business needs to carry a lot of debt to finance its operations. So all of these things are things to look at. Really, the key, again, my key kind of comments to you as the business buyer is keeping track of changes in the balance sheet accounts, understanding why changes happen. Another thing to look at is, are there any deposits, work in progress, deferred revenue, to understand what type of interim accounting is being done for potential project-based work or deposits that are received and how the funding cycle works for customers. So in this situation, there is no deposits, but in other situations there may be. What is the historical CapEx? So really zeroing in on what is a true sustainable CapEx, because that will factor into your free cash flow analysis when you're looking to buy a business and value a business. We already talked about the fact that if the business owns the real estate, there may be tax implications involved. Another one is cash. So when you look at a balance sheet, how much cash is on the books? If more than 51% of the value, this applies to Canadian businesses, but if more than 51% of the combined value of the cash plus the value of the business is associated with the cash, then really there may be complications around being able to qualify for the small business qualified shares, which allows the seller to sell the shares of the business. So just to say that in a different way, say for example, the business is worth $2 million and there's $4 million worth of cash on the balance sheet. Well, that means there's 4 plus 2 is equal 6, but 4 divided by 6, there's more than 51% of the values associated with the cash on the books, and therefore the business will not qualify for the small business capital gains exemption, because there's more passive assets in the corporation than there are active assets associated with the business operations. So the Canadian government and the CRA does not view that as a qualified business that will get the benefit of the capital gains exemption. So those are things that, again, hopefully the broker has flagged that, but if they don't, then you probably need to talk to the seller about that to help them understand that that's something that's going to influence their net proceeds from a sale. Are they still interested in selling, and at what price? And then, we kind of talked about the related party in the long-term debt, really understanding the funding, any funding sources on the balance sheet. Why do they exist in the first place? Is that required? Is that simply their situation and the way they've chosen to fund the business? Or are there actually needs around financing because of the working capital cycle and the cash conversion cycle that exists in that business? So it all depends on the situation. But again, starts with checking the trends and then going into each individual account to understand why that account exists in the first place. So let's actually look at this business, for example. When we look at CapEx, an easy way, you may not have the financial statements. So what I like to do is I actually just like to use the balance sheet and the income statement to determine the annual CapEx for the business. And the formula is very simple. Annual CapEx is the current year PPE minus the last year PPE plus the depreciation in the current year. So let's just look at, I just kind of presented the calculation here. So in 2017, the current year was 688,000. Now I know in the last year was 713,000. So that's last year, plus the 72,000 was the amortization on the P&L of the business. So this minus this plus this equals 47,000. Same thing, 621 in 2018, 688 in the last year, which is 2017. Plus the amortization in 2018 was 65,000. There was no new assets that were bought. It was mostly depreciated with some small asset sale. And then in 2019, there was a huge CapEx jump of 142. So the question for the broker would be, well, why in 2019 was there a huge investment? What happened? What did they buy? Is that going to happen in the future again? So really understanding the CapEx needs of the business is critical for a buyer. The second analysis is really around the accounts receivable, any type of inventory or accounts payable collection. And so how does that look? So in this situation, because in 2019 there was a huge jump in AR, and we identified that previously, the collection cycle has extended relative to the sales of that business. So really, the days sales outstanding has trended up from 24 days, 36 days to 77 days. And then the days payable outstanding, which is really accounts payable and accrued accounts payable relative to the sales, has gone up from 39, gone down to 13 days, but then just jumped back up to 43 days. So really the biggest comment I would say is accounts payable is okay. It's not like there's no real big trend here, but definitely you have to zero in because your collection days has doubled year over year between 2018 to 2019 and this year. So how does that tie into the broader story in the CIM? Maybe they've changed their business model and moved towards more project-based work, and therefore that service company has more AR to collect on, or maybe the market's slowing. customers are weak and can't pay as quickly as they were in the past. So understanding those trends and how that ties into the business. Okay. So the last area that we're going to focus on is the asset and equipment list. And so here, some businesses that are asset based or the manufacturing, service, contractors, they may give you a breakdown of the assets in the CIM. And so the key question here is just understanding how old the units are versus their useful life. Because oftentimes for these smaller businesses, especially when a business owner is going to ramp up to sell their business, they stop reinvesting in the asset base. They don't invest in the same level of CapEx anymore because, hey, I'm not going to own the business for the next couple of years, so why should I put money into the business? But from your point of view as the buyer, you want to understand if you're stepping into a situation where you have to buy a couple key assets to continue delivering the services of your business in the next year or two, which really increases your acquisition cost and the burden of debt on your business. So that's it. So definitely the first most important question is when you look at the asset list. And so say, for example, here, this is a service-based business. It has a couple vehicles, 11 vehicles. So really it's a simple asset list, but definitely the concern here is this is a vehicle list as of 2024, and some of the oldest active vehicles in the fleet right now are 22 years old. Chevy Silverado 1500, 2002. Apparently it's valued at $5,000. Is that even realistic? That's another question. Definitely, I don't think a 22-year-old vehicle is worth $5,000. So probably the broker in this example has inflated the value of the asset relative to what it's truly worth. But also, how many more years can you run this Chevy? For 22 years it's been going, most likely that vehicle needs to be replaced. So does the business need 11 vehicles? Can it go down to 10 and run on 10? Or does it need 11 or maybe even 12? And therefore, not only do you have to replace this Chevy, but then you have to add another one. So really understanding the replacement cycle of the asset base relative to the asset list that's given in the CIM is really the key thought for me whenever I look at the asset list in a CIM. So, the question here is, when you look at the age of these vehicles in general, has the owner just generally underinvested in the business? And therefore, that gives you an indication of the type of owner that they're at, that they are. Other businesses we're selling right now, one where it's a motor coach business, they have regularly invested in their fleet and have actually overinvested and have a very modern fleet. So in that situation, there's a lot of ownership pride and the owners want to continue to reinvest. So that means there's less problems for the buyer. But if a seller is underinvesting in the business, there's more unforeseen costs in the future that you need to factor into your purchase price. So sometimes buyers will simply look at these assets and say, well, I'm going to need to replace these three assets. It's going to cost me $60,000 a vehicle or $70,000 a vehicle. So, 70 times 3, 210. So 210 comes off the price, and I'm just going to factor that into my acquisition cost, and I'll make that investment myself. But again, these are things that you need to think about. And another one is, is it worth getting an asset or equipment appraisal? And usually equipment appraisals cost anywhere from about $3,000 to $10,000. I would say for the smaller businesses where there's just a couple vehicles, it doesn't really make sense. I would say in general, if the assets make up more than 50% of the total purchase price, then it probably makes sense because you can get that appraisal and then get better financing terms associated with it. But say, for example, the assets are worth only 10% of the true goodwill value of that business, then it's probably not worth over-investing in understanding the asset-based value because it's a lean asset-light type business. So it depends on the type of business, but I would say anywhere from about a third to 50% of the value. If it's in assets, then it's probably worth at least getting an appraisal to understand what the true asset value of the business is today. Okay, so just to summarize everything, a very long video. Hopefully you guys have stuck with me throughout everything here. But at a high level, when you look at the CIM financials section, I would say here are a couple things you can do. The first one is ask for the source account and prepared statements. If they're going to give it to you, perfect, because then you can kind of rebuild your own EBITDA schedule and cross-check the EBITDA schedule that's given to you in the CIM. Other times you may not be able to, but if you can get your hands on it, it's perfect because I always look at the financial notes in the back of the account and prepared statements to really get a sense of what the accountant is highlighting as key trends or changes year over year. Now, the second bullet point is a very important one. And I've had a couple buy-side conversations with buyers where you look at the EBITDA schedule and it's just plain wrong. It's really aggressive. They missed a couple adjustments on rent or on other income, whatever the case is. And so the EBITDA is substantially different. So maybe the buyer sees the EBITDA as 50% less than the EBITDA presented in the CIM. Well, the challenge is bad brokers that mismanage their clients' expectations make bad clients, because the client doesn't know what they're doing. Really, they're hiring a broker to help them sell their business and prepare the package and prepare the financial model. But if the broker is really aggressive, most likely the broker has set expectations very high. And for you as a business buyer, you need to determine, is it worth even investing my time to look at this deal, or should I just move on and find something else? Because at the end of the day, bad brokers make bad clients, and you sometimes can't change the client, especially when you can't get in front of the client because the broker is in between you and the client. So don't try to waste your time with bad deals. There's a lot of deals out there, and sometimes these deals are mismanaged and they're tainted. And unless that broker changes and they hire someone else, it's most unlikely that you're going to be able to kind of negotiate a competitive deal with that broker in that situation. Now, I say in general, the financial story should always tie into the broader CIM story. If there's a difference in the numbers between what's being told in the CIM on the quantitative side and the qualitative side versus the quantitative side, then that doesn't make sense, because the numbers should support the CIM story as a whole. If it's not, and there's a difference there, there's a red flag that you should be digging into. And then really in terms of the quality and the different tiers that I look out for, this is just a general rule of thumb for me, but whenever I zero in on EBITDA margin or gross margin, I always really want to look for a higher margin, because the higher the margin, the more buffer for error you have as the buyer and the operator, but as well, the more value add that business is able to extract premium gross margin or profit margin from. Right? If you're just a low value distributor, you may have a 20% margin and between 0 to 5% EBITDA margin. But say, for example, you're a highly technical engineering services business, you may have a 40% EBITDA gross margin and a 20% net margin, because there's less assets, it's a much leaner P&L, and you can convert your sales to profit in a much higher rate. So ultimately, the higher the gross margin, and usually you kind of want to be in that 30 plus gross margin range and at least 15 plus EBITDA range, the higher the quality of the business, and usually the higher the price of the business is as well. So sometimes I have business buyers that come to me and they show me like a low value distributor that doesn't do anything outside of just picking and packing or just unboxing the asset and then distributing it to smaller accounts. The challenge is that business is susceptible to industry change and competition because there's low barriers to entry and there's a lot more risk associated with that. So unless you get a stellar deal, an amazing deal, it's probably not the right business to buy for your first business. So I really like to focus on these a lot. And then lastly, the quality of the financials. There's 3 tiers to the financial statements. There's notice to readers or compilation reports, depending on the region that you're in, review engagement statements, and audited statements. In SME transactions, I would say 99% of the time it's either going to be a compilation report or a review engagement report. Very rarely do you see audited statements. But if it's a compilation report, just recognize that there's no compliance, no insurance, no assurance provided by the accountant to the quality and accuracy of those numbers. All they're doing is assembling the numbers and putting it into a format of a financial statement. Versus the review engagement statements, there is a review, there's a financial review, and there's audit testing that's done to assure at least some level of quality to that information. So just be careful. Sometimes when you're looking to buy businesses and the information is prepared on a compilation report basis, don't take those numbers as gospel. Still do the due diligence associated with that. Versus review engagement statements, you can actually get bank financing simply with review engagement statements because the banks are comfortable with the assurance provided by those statements. So it depends again on the quality of the statements, your level of review of the accuracy of the numbers as well. Okay? So that's the end of part 1. pretty long one, but hopefully you found it really helpful. There's a lot of detail there. Again, I recommend that if you have a deal, there's a lot here and there's a lot to cover, but I'm more than happy to take an hour of my time, sit down with you and actually look at a deal live, send the information over, sign an NDA, and we can go through the process and we can kind of go that way. Or if you have a couple questions that you want to ask, you can comment below or reach out to me over LinkedIn and we can connect that way and have a quick discussion. But overall, hopefully you found the video helpful. Part 2 will be coming out next week, so I'll release it in weekly intervals, and we'll now in part 2 video jump more into the qualitative side of the business, which is really the customer, suppliers, and really the business operations and the strengths and weaknesses of that industry. So appreciate your time, guys, and have a wonderful day. Bye.